The Balanced Scorecard (BSC) is a management reporting tool that translates an organization's vision and strategy into a set of performance measures across 4 balanced perspectives. Objectives: 1. Provide a clear link between strategy and day-to-day operations. 2. Give managers a broader view than pure financial statements, so they can see leading future-oriented as well as lagging indicators. 3. Encourage learning and continuous improvement. 4 perspectives: think of a car's dashboard. Financial, traditional metrics such as revenue growth, profit margin, ROI. Customer, measures of satisfaction, market share, net promoter score. Internal business processes, efficiency, quality, cycle time, innovation rate. Learning and growth, employee skills, turnover, culture, information systems. Each perspective asks a simple question. Financial, are we delivering value to shareholders? Customer, are we delivering value to customers? Internal, are our processes able to meet the promised value? Learning, do we have the capability to improve and sustain? The BSC balances short-term financial outcomes with long-term drivers of future performance. A strategic map is a visual diagram that shows how objectives in the 4 BSC perspectives are linked causally like a chain of dominoes. The step-by-step construction. Start with the ultimate financial goal, for example, increase net profit by 10%. Ask what must happen in the customer view to achieve this, maybe higher customer loyalty. Then ask what internal processes must improve to raise loyalty faster, order fulfillment. Finally, identify the learning and growth enablers, employee training on new logistics software. Cause-effect example. Training leads to better use of software, leads to faster fulfillment, leads to higher customer satisfaction, leads to more repeat purchases, leads to higher profit. The map works like a recipe. Each ingredient objective contributes to the final dish financial result. By making the links explicit, managers can see where to invest resources for the biggest downstream impact. Choosing KPIs is like picking the right gauges on a dashboard. They must be relevant, measurable, actionable, and aligned with the strategic map. Number 1. Selection. For each objective, pick 1 to 3 indicators that best capture performance. Example: for the employee training objective, use % of staff certified on new system and training hours per employee. Number 2. Weighting. Not all KPIs matter equally. Assign a weight W sub I that sums to 1 within each perspective or across the whole scorecard. Example: financial perspective may receive 40% of total weight, customer 30%, internal 20%, learning 10%. Number 3. Scoring. Convert raw data to a standardized score, usually 0 to 100 or 0 to 5. A common formula is score sub I equals actual sub I divided by target sub I times 100. If actual exceeds target, cap the score at 100 or allow a bonus ceiling. Example: target for on-time delivery is 95%. Actual is 92%. Score equals 92 divided by 95 times 100 equals 96.8. Number 4. Documentation. Keep a KPI dictionary that records definition, data source, frequency, and owner. This prevents misunderstandings later on. Target setting defines the desired level for each key performance indicator, the goal line on a racetrack. Targets can be absolute, for example, $5 million profit or relative 10% improvement year over year. Composite BSC score combines weighted key performance indicator scores into one number that tells you how well the whole strategy is executed. The mathematics are straightforward. Individual key performance indicator score as above. SI equals AI divided by TI times 100. Weighted score per perspective. WSP equals sigma WI times SI for all key performance indicators I in perspective P. Overall composite score. CS equals sigma WP times WSP, where WP is the perspective weight, for example 0.4 for financial. Interpretation. CS greater than or equal to 90 means strategy is on track. Celebrate. 70 less than or equal to CS less than 90 means good, but investigate low-scoring key performance indicators. CS less than 70 means significant gaps, corrective action needed. Example: suppose we have 2 key performance indicators in financial, revenue growth and margin. with scores 110 and 85, weights 0.5 each within the perspective, and the financial perspective weight is 0.4. WSFIN equals 0.5 times 110 plus 0.5 times 85 equals 55 plus 42.5 equals 97.5. CS equals 0.4 times 97.5 plus 0.3 plus 0.2 plus 0.1 complete with other perspectives. This arithmetic gives a single comparable figure for board reporting. Traditional financial statements tell you what happened while the BSC tells you why it happened and what will happen next. Integrating both gives a richer analysis. Link to cost volume profit CVP. Variable cost per unit can be tied to an internal process key performance indicator such as units produced per labor hour. Improving that KPI lowers the variable cost, shifting the cost volume profit break-even point leftward. Financial to non-financial mapping. Revenue growth financial may be driven by the customer KPI market share in target segment. By forecasting how a 2% increase in market share translates into $1 million revenue, you can embed the estimate in the budgeting model. Variance analysis. When a profit variance occurs, drill down to the BSC, a negative margin variance could be due to a low internal KPI score for production defect rate, higher rework costs. This provides a concrete action path rather than a vague cost over an explanation. The integration creates a feedback loop. BSC improvements affect financial results, and financial outcomes validate the relevance of BSC measures. Explanation cascading means copying the corporate BSC down to each business unit department, and even individual, but tailoring the language and metrics to the local context. How it works. Top-level scorecard sets the overall strategic objectives and perspective weights. Business unit scorecard adopts the same 4 perspectives, but selects KPIs that reflect the unit's specific market or product line. The unit receives a portion of the corporate weights, for example, 30% of the financial weight. Functional scorecards marketing might focus on customer acquisition cost, operations on cycle time, HR on training hours. Their scores are rolled up to the unit level. Individual objectives, each employee gets measurable targets that feed into the functional KPI. For example, a sales rep % of new accounts contributes to the marketing new customer growth KPI. Analogy. Think of a Russian nesting doll. The biggest doll corporate defines the overall shape. Each smaller doll unit function person fits inside, sharing the same outline but with details appropriate to its size. Cascading ensures alignment, prevents siloed goals, and makes every employee accountable for the strategy. The BSC becomes a living part of the budgeting and control cycle. Budget formulation. When setting the annual budget, managers allocate resources to the initiatives that score high on the strategic map. For example, if the Employee Innovation Program KPI has a high weight, the budget will contain a line item for its funding. Variance analysis. After the period ends, compare actual KPI scores and financial results against budgeted targets. A variance in the on-time delivery KPI can explain a cost variance in overtime wages. The BSC thus turns a pure dollar variance into a narrative of cause and effect. Management control systems, MCS. The BSC feeds into performance appraisal, incentive compensation, and dashboard reporting. Scores can be linked to bonuses. For example, 20% of bonus based on achieving the composite BSC score. This reinforces strategic behavior. By embedding the BSC into these processes, organizations move from reactive budgeting to proactive strategy execution. Financial perspective weight equals 0.4, customer equals 0.3, internal equals 0.2, learning equals 0.1. Financial key performance indicators. Revenue growth, target 8%, actual 10%, weight 0.6. Net profit margin, target 12%, actual 10%, weight 0.4. Customer key performance indicator. Net promoter score, target 70, actual 65, weight 1.0. Internal key performance indicator. Cycle time, target 5 days, actual 6 days, weight 1.0. Learning key performance indicator. Training hours per employee, target 20, actual 22, weight 1.0. Step 1. Convert each key performance indicator to a 0 to 100 score. Revenue growth score equals 10 divided by 8 times 100 equals 125, capped at 100. Profit margin score equals 10 divided by 12 times 100 equals 83.33. Net promoter score equals 65 divided by 70 times 100 equals 92.86. Cycle time, lower is better. Score equals target divided by actual times 100. 5 divided by 6 times 100 equals 83.33. Training hours score equals 22 divided by 20 times 100 equals 110, capped at 100. Step 2, weighted score per perspective. Financial weighted score equals 0.6 times 100 plus 0.4 times 83.33 equals 60 plus 33.33 equals 93.33. Customer weighted score equals 92.86. Internal weighted score equals 83.33. Learning weighted score equals 100. Step 3, composite score. Composite score equals 0.4 times 93.33 plus 0.3 times 92.86 plus 0.2 times 83.33 plus 0.1 times 100 equals 37.33 plus 27.86 plus 16.67 plus 10 equals 91.86. Interpretation, overall performance is strong, approximately 92. The weakest area is internal processes, 83, suggesting a need to improve cycle time. Exam takers should memorize the score formula, know when to invert a metric, cost type versus benefit type, and practice capping scores to avoid inflated numbers. Common criticisms. Number 1, complexity. Too many KPIs can overwhelm managers. The system can become a paperwork exercise. Number 2, subjectivity. Choosing weights and targets may reflect personal bias rather than objective analysis. Number 3, static structure. If the market changes quickly, the original strategic map may become outdated, requiring frequent redesign. Number 4, over-reliance on non-financial measures. Some firms may neglect essential financial discipline if they chase scores that look good but cost money. Comparison with conventional financial measures. Financial metrics, ROE and EPS, are lagging, easy to calculate, and universally understood, but they hide the drivers of future performance. BSC adds leading indicators, customer satisfaction and employee learning that give early warnings, but they require data collection systems and managerial judgment. When to use which? Start with financial measures for short-term health checks. Add BSC when the organization seeks strategic alignment, wants to manage intangible assets, or operates in a dynamic environment where future performance matters more than past results. In practice, most mature firms run the two in parallel. Financial